In this first presentation of the U.S. debt crisis, I'm going to show you how our national debt has been built up over the years. Now, bear in mind that the figure that you see here is as of September 15th, 2011. My name is Pat Obi, Professor of Finance at Purdue University, Calumet. First, a look at the national budget, because as you know, it's the deficits from the budgets that add to our national debt. So what you see here is actually in the period from 96 up to the projected period of 2012, how the national budget submissions have grown from $1.6 trillion in 96 to a projected level of $3.7 trillion in 2012. These are all mind-boggling figures, especially considering the fact that what you're seeing here is more than twice the size of what it was just a few short years ago. All right. So here's the way it looks, our fiscal spending. Now, this is the 800-pound gorilla right here, because you can see about 60% of our national budget, at least 60%, is bound up in spendings that government can ill afford to control. Look at Medicare and Medicaid, which is 23% of the pie, Social Security, another 20%, defense spending, another 20%. So look at all these. There's not much government can do about it, except perhaps a little bit in the Defense Department right here. But additionally, look up here. There's other mandatory spending by government, salaries and wages for government workers, maintaining federal services and stuff like that. And of course, look at here. We do have interest payments. These are also mandatory. So as you can see, just about the only part of our national budget that provides any wiggle room is actually the discretionary spending. In the year 2010, it's no more than about $660 billion. So if you're going to have to cut spending, then you're going to have to dig into the unfunded mandates, the Medicare, Medicaid, Social Security, and these are some pretty touchy issues in the United States. And of course, I think we have eventually come to the understanding that slashing down defense spending has got to be done. All right. So bear all this in mind, noting in particular that the only wiggle room right now is just no more than about $660 billion, and perhaps a little bit off of the Defense Department. The total wiggle room that government has is no more than, you can look at these two numbers. If you take a little bit here and add it to over here, it's not gonna be any more than $1 trillion unless some bold steps are taken to wade into these uncharted territories that can make or mar the election of a president and Congress. But look over here. This is only how much we're picking up. Just a little above $2 trillion. So a little above $2 trillion, compare that to a little less than $3.5 trillion. That's our deficit. Most of our money comes from individual income taxes. Not a whole lot comes from corporate income taxes. That's not such a big deal. I guess the big deal here is that right now we're relying a whole lot on Social Security and social insurance taxation, which right now we do have surplus in the trust fund, and government borrows from that surplus to help fund part of this huge spending that you see right here. All right, so let's see what we got here. Of course, the deficits add to our national debt. So let's take a look at it. That's what the situation has been for several years. And you can see that the lid kind of popped open shortly after the Second World War with the Marshall Plan and the GI Bill. So it kind of popped open, but it didn't really go crazy until the 80s, which, as you may remember, that's when President Reagan came into office. And then from then, there's been no looking back. And this has continued to rise, money spending is going out of fashion. Well, in recent years, this is what the situation has been. In the beginning from the time of President Carter all the way to now President Obama. But observe here, first, look at the levels, the additions to our national debt under each of these presidents. But what's more important, actually, is by how much our national debt rose during each segment. For example, under President Jimmy Carter, our national debt grew by 33%. Let's swing over here under Obama. Within a year, it's up by 34%. And then if you go back a little bit, under George Bush, which is actually when things started getting really out of hand, it went up by a whopping 63%. But then hold your breath. Let's go right back over here to President Ronald Reagan. All right. Now, he was obviously a very popular president, but look over here. Our national debt actually grew by about 160%, the highest it ever grew under any of our recent presidents. So, what happened during that time? A lot of money was spent building up the cruise and Pershing missiles, Star Wars, and of course he offered a lot of reduced taxes to citizens, but also eliminated a lot of tax deductions. But a lot of money was spent here. But we didn't really care so much because also at that time the economy, especially toward the ending part of his first term, and for the most part in his second term, the economy grew rapidly, and so no one really cared about the national debt, which is often the problem here in America. When things look pretty, no one cares about how much money we're borrowing. But you can see that economic growth came at a very high cost. So who are our money lenders? Well, a third, approximately, are foreigners, and that's the unfortunate part of this game right here. All right, so you can see that no more than about 27% as of the first quarter of 2011 of total debts that was raised by government actually came from American citizens. Well, the remaining 42% is actually intra-governmental borrowing, which is when the federal government borrows from another agency of the federal government. And you might say, wow, how does that happen? But remember what I said earlier. Think of the Social Security Surplus Fund and the Medicare Surplus Fund. Well, what do you think happens to all those surplus funds? The federal government borrows all that money to finance our national debt. And so what happens, eventually, when those surpluses run out, when the recipients of Social Security, when the money we pay them is more than the money coming in, government is going to have to cough up, all that money it borrowed plus interest. And so that's a liability that we have to face at some point in the future. But the troubling thing here, though, is the fact that the proportion of money owed to foreigners has risen steadily over the years. And of course, our heaviest lenders are China and Japan. China in particular. And many people say, well, how does that really happen? Does America go on its knees with cap in hand and say, hey, China, lend us some money? It doesn't quite happen exactly that way. Remember, China has a huge trade surplus with the United States, resulting in huge current account surplus to China and a huge current account deficit to the United States. So with all that surplus, China figures, well, we have two choices here. We can either sleep tightly on all that huge surplus we made from selling a bunch of made in China stuff to the United States, or, by the way, we can take all that surplus money and lend it to the U.S. by purchasing U.S. government bonds. Why would China want to do that? Well, if they just hold on to the cash, there is no rate of return on it. But if they lend that money to the U.S., they at least stand to earn some interest on it, which actually leverages their trade surplus position, much though as it puts additional financial encumbrance upon the United States. So, but that's the story right here. And you can see that 26% of total debt held by foreigners belongs to China, with well over $1.3 trillion in U.S. bonds within its reserves. All right. So, well, I'm not going to let you go before without mentioning this point that actually, if you look up here, just look at the red line and the green line. The red line shows the trend in the amount of money borrowed from U.S. citizens, and the broken green line right here shows the amount of money borrowed from foreign investors, largely foreign central banks and sovereign governments like China, Japan. You saw all that. But see how it is that in the early part of the 2000s that trend crossed the the borrowings from U.S. investors. I don't know what happened, but foreigners seem to fall deeply in love with U.S. government bonds. I suppose that might have been encouraged by the huge run-up in housing prices in the United States prior to the collapse in 2007, as well as the run-up in stock prices at that time. So I suppose foreign investors say to themselves, gee, this is still a beautiful economy to invest our money. And actually it is, you know. But anyways, they may have overshot the bow. And as you can see, just about when the housing crisis broke in 2007 was when foreigners for real overshot American investors in the purchase of U.S. Treasury securities. And in fact, that trend has even widened over the years. So you would have thought that the global financial crisis would have discouraged foreign investors from purchasing U.S. government securities, but actually it accelerated after the housing crisis in 2007 and the ensuing global financial crisis, which of course started from the U.S. mortgage market in 2008. So that's the story for now. And so the next question we're going to have to ask ourselves would be, well, has the U.S. borrowed a little too much than it can handle? Well, that's a good question worth asking, and we're going to have to explore that in the next segment of this presentation.